what is risk management in forex trading and how to manage risk in day trading. Hello everyone and welcome to the channel. My name is Shah and you are watching your own forex channel, FX Shah. 90% of forex traders lose their money uh, within 90 days, right? So if you don't know about the 90-90-90 rules, it means that 90% of trader lose their 90% capital in 90 days, right? So what is the important factor that those traders lose their money? Because they don't have risk management in place. In today's video, we will talk about risk management, and we will talk about that what is risk management, right? In Forex, how to manage your risk in day trading, and why risk management is so important, right? So the first point is that what is risk management in Forex, right? So risk management is a most important part of Forex trading, right? In which we know that how much money we have and how much money we can risk on our trades, right? And management part is that we manage our risk according to our trading plan, and we know our probabilities in our backtesting part when we backtest our strategy according to our backtesting uh, time, right? And importance of risk management is that we know that what will be the probability in future and what will be our outcome, right? So now we will go to a greater detail that what is risk management, right? So trading versus gambling, right? If you are a forex trader, so you have a risk management in place, right? If you don't have risk management in place, so you are a gambler, right? What is the mentality of gambler and what is the mentality of a forex trader or stock trader or future trader? If you are a gambler, you want to make quick buck. If you want to make a quick buck, so you are running after opportunities, you are risking your whole capital on single trade, right? For example, if you talk about a trader, right, which will be our first part. If a trader want to trade, the trader is trading for a longer term, right? So he have a predefined rules, right? He can trade only 1% of his account or her account per trade. He can open only two positions a day, right? And he knows the probability of his trading that I have a back tested and a proven strategy which allows me to trade only 1% of my capital twice a day, right? So in the longer run, if he take a number of trades, for example 100 trades a month or 100 trades a quarterly, so he knew his probability that I have a 60 70 to 80% win rate, right? 70 to 80% win rate on which I can make money, right? So this is a trader forex trader mentality. And what is the mentality of gambler which do gambling? He want his whole money to bet on a single opportunity. If he lose money, he lose it at all. If he make money, so he double it, right? So this is the difference between trading and gambling, right? So please don't take it as a gambling. Consider and do it as a trading, right? Because in gambling you as always you have a high risk to lose it once, right? So if you are a trader, right, not a gambler, so in risk management we have three main components, right, which are risk, capital, right, how much capital we have that we are comfortable that we can lose that capital and which will not affect us, right? And the gamble mentality, you lose everything, you do it again and again and you ruin your life. But in trading psychology, you have a predefined capital which you risk and which will not affect us. Risk per trade, so how much you can lose or how much you want to lose per trade, right? And instead of gambling mentality, you have a plan that I am risking a percentage of my account per trade, right? Gambler, what the gambler do? Gambler lose everything and risk everything on a single bet. But if you are a trader, you on a single bet, you don't lose everything, right? You have predefined rigid rules, right? If you have a trader mentality, you know your maximum exposure, right? Maximum exposures mean that you can expose your capital to a market on daily basis or weekly basis on a percentage, right? So for example, if you have $100 account, right, you have $100 account, you want to risk 1%, which is $1 a trade, right? And you want a maximum of exposure per day 2%, right? Which is $2 a day, right? So you know that I have a trading plan that I can risk only $100 of my capital, 1% per trade, and my maximum exposure per day is $2, right? So this is a trader mentality. If you are a gambler, what he do? He don't consider capital which he or she want to risk. He don't or she don't care about the risk per trade or risk per bid, and he don't care about the exposure. The trader, the gambler mentality is he take or he take the whole $100, right? The whole $100 and uh, risk it on a single bet, right? A single bet. So if he or she wins, he double it. But if he or she lose, he lose or she lose it once, and he or she don't have anything remain to do it the next day. But now, if you are a trading mentality, you just lose 2%, which doesn't matter at all in your 100% capital, and you can make it in your trading career, right? And the next point, we have sizing and stop loss types, right? So position sizings and stop loss types, if we talk about a position sizing at that, how much money you want to risk per trade, as we discussed, right? So if you are losing, you consider you are agree to lose 1% in our risk per trade part, 1%, right? So in 1%, which is equal to $1 in $100 account, right? In $100 account, which is 1% risk is $1. So in stop loss, if you have a zero point 0.0 lot open, so which is equal to 10 pips, right? So you can enter to a trade which has a 10 pip stop loss, right? Which has a 10 pip stop loss. So this is the type of risk which you consider taking, right? After that, you have stop loss types, means that you want to risk a percentage of your account, right? So if you want to percentage of your account which is equal to 1% and $1 for 10 pips, This is a percentage type of stop loss, and some guys use fixed stop loss, right? Which means that if you have $100 account or you have $1,000 account, you risk a percent, not a percent, you risk a fixed amount, right? So if you have a $100 or $1,000 account, you risk $10 a trade, right? Which is a fixed risk per trade. But some traders use their percentage in trading, which is the best way, right? In a stop loss bot, always use a market structure, right? Fixed stop losses always get hit, so use a position sizing, right? For example, if you have a $5 risk, right, $5 risk, and you have a stop loss of 50 pips, so divide it in the with your per risk and put that stop loss accordingly, right? If you want to survive the market, if you want to survive the market, always predefine your risk, always use a proper stop loss, right? If you don't use proper stop losses and you don't know about your risk, in the longer run you will lose money. Importance of the risk management is very crucial, because if you don't know about your risk management, you don't know how to manage it, in the longer run you will lose your money, and you will not make it. The market rule is that if you survive today, you can do it tomorrow. If you don't survive today and you don't have anything in hand or in account, you cannot do it, right? So always use proper risk management, always use proper stop losses, right? And before going live to any trading, always back test your strategy, and according to that strategy and uh, based on the results of that strategy back testing, create a trading plan, and according to that trading link, follow those rules rigidly, right? If you don't know about the back testing or strategy or trading plan, right? So I have created a mini series on that topic, which is a trading system and strategy mini series. I have put the link for that mini series in the description. You can watch that yourself, and you will know that how you can create your own strategy, how you can back test that strategy, and based on the back testing on you and your strategy, how you can create your training plan, including your risk management, to be a profitable trader. So these are three basics and most important parts, right? That you have a mindset of trader, right? Not a gambler. You know, and you have everything in place, risk management in place, that if I lose 10,000, 5,000, $2,000, it doesn't matter at all, it will not affect my life. I risk only a percentage of my capital per trade, and my maximum exposure per day or per week is fixed, right? And according to my trading plan, I use a positioning sizes based on my capital and risk, and maximum exposure to enter to a trade with proper stop loss, right? So in the longer run, if I have a proven strategy with the win rate a percentage of 80%, right? And I take 100 trades, take 100 trades. If I lose 20 trades, and the 80 trades I make 80% or $80, which depend on your fixed type of stop loss strategy or percent type of strategy, stop loss strategy, and you have no issue with it, right? So this is the whole scenario for your risk management. I hope you guys get an idea that what is risk management, how we have a trading mentality, not a gambling mentality, and what is risk capital, risking per trade and exposures, everything. So if you have any question regarding risk management or position sizing, right, or exposure or stop losses, trading plans, strategy, anything, please comment below. I would love to get back to you guys. That's it for today. Have a great day. See you in the next video. Bye bye.